Thanks, Julie, and thanks everyone for joining us this afternoon. I know we only have about 30 minutes scheduled for this webinar, so I'm going to jump right into the material. My goal is to leave a little bit of time at the end for questions, and if we go over the time limit, I'm happy to stay online and answer any questions that people have that we don't get to. I know that we have people listening from a variety of different backgrounds, and some may have more or less familiarity with tax concepts generally, and some people may even be familiar with IC discs. I really wanted to target this discussion as more of an introduction to the IC disc concept, so I apologize if it's a little slow for some, but hopefully everyone will find something interesting and learn something new as part of it. So let me get my slides to advance here. I was trying to figure out where to start today, and I thought the best way to begin would be to just give a general overview of what an IC disc is, and then dig into the details of how they work, what the benefits are, and who qualifies to use them. So what's an IC disc? The term itself is an abbreviation for, and this is quite a mouthful, Interest Charge Domestic International Sales Corporation. So really a sexy name for a really exciting concept. But at its core, an IC disc is a tax strategy which can benefit U.S. businesses which sell certain types of products or perform certain services which are ultimately used or performed abroad. I didn't use the term just exporters in describing who can benefit because I wanted to emphasize that a business doesn't have to sell directly to foreign customers to qualify, so long as the products are ultimately exported. For example, a farmer who grows soybeans in the U.S. and sells them to a middleman, who then sells a portion to a foreign distributor, could qualify. We'll get into how IC disc structures work in more detail, but setting up an IC disc basically involves the owners of an existing business setting up a new separate corporation which elects to be treated as an IC disc under the tax code, and a portion of the earnings of the existing business are then basically shifted into the IC disc, which produces the tax benefits that we'll discuss. Since an IC disc is a separate company, it files a separate tax return. In 2008, which is the last year that the IRS released these numbers, 1,917 IC disc returns were filed. I'm sure this number has gone up since then, but what's amazing is that the number is probably only a very small fraction of the number of businesses who could use these structures and see a significant tax benefit. One question that I frequently get when I talk about these issues is this a tax shelter? And I think the answer to that question is no. It's really a tax incentive, and what I mean by that is a tax benefit that was intended by the law, but it is a fair question. After all, if the government wanted to just support exports, why make taxpayers go through this weird process of setting up a new company and shifting income into it? Why not just put a line on your tax return and allow some type of deduction or credit to reduce your taxes? I think the answer to that question lies somewhat in the history of various export tax incentives that have been enacted over the years, and particularly it has to do with the conflict between the U.S. government's objective to provide a tax incentive to support exports and international trade agreements that we're a part of, which generally prohibit countries from directly subsidizing exports. So a little bit of a brief history lesson about these. The DISC, and that's without an IC, rules were enacted in 1971 as an export incentive. The original rules allowed qualifying taxpayers to set up a new corporation, elect to treat it as a DISC, and then, as we've said, basically divert a portion of their export profits into this DISC. And by qualifying as a DISC, the new company was exempted from tax on its income. So this income wouldn't be taxed until it was distributed back to the shareholders or back to the company as a dividend. What this did is basically allow taxpayers to effectively defer the tax on a portion of their income related to export sales pretty much indefinitely. The DISC rules were ultimately challenged by U.S. trading partners in Europe as an illegal subsidy in 1976 under the General Agreement on Tariffs and Trade, which was sort of the predecessor to the World Trade Organization. So in 1984, Congress finally, gave in and repealed the didn't repeal the the DISC program, but changed the rules. It allowed taxpayers to continue to use DISCs and shift income into DISCs, but it imposed an interest charge on any tax that was deferred by using the structure. So you could still use the structure, but if you got this tax deferral benefit, you had to pay an interest charge on the tax that you were deferring until later. So it cut down pretty drastically on the benefit of the structure. In the same year, Congress also enacted a new export incentive, and this was really, they were trying to enact something that provided more benefits and that would survive these challenges by under international trade agreements. So the new rules were called the Foreign Sales Corporation rules, the FSC rules, and these were largely seen as more beneficial to taxpayers. So people really stopped using IC discs around this time. So FSCs were around for about 15 years until they too were challenged and ruled to be an illegal export subsidy by the World Trade Organization in 1999. So in 2000, Congress agreed and or relented and repealed the FSC rules and tried a third time to find an export incentive that would stick. So it passed the EIE rules, which stands for Extraterritorial Income Exclusion Rules, in 2000, and those were challenged almost immediately and held to be an illegal subsidy. So after Strike 3, Congress sort of gave up and repealed the EIE and didn't replace it with anything. This basically left the IC disc as the only remaining export incentive on the books. Another major development happened about a year before, in 2003, when the Bush tax cuts took effect, which, as you may recall, lowered the tax rate on dividend income. Whereas dividends had previously been taxed at ordinary rates, they were now taxed at the lower capital gain rates, which was a flat 15% at the time. And at that time, tax professionals realized that although there was still this small deferral benefit to IC discs, subject to the interest charge that you had to pay, the change in the dividend rate created another benefit and potentially a bigger benefit. Because the IC disc is a corporation, it pays out its earnings as dividends. So a business using an IC disc could take a portion of the income on which it was previously paying tax at ordinary rates, at the time were up to 35%, and shift it through the IC disc as the rules permit, and turn it into income that was taxed only at the lower dividend rate. We'll walk through an example of this, how this actually works later, but essentially, the moral of the story here is that the disc rules were created in the 70s with a strong export benefit. They were weakened over the years because of complaints from trading partners about us subsidizing exports, and then they got a new benefit later on because of changes in the tax law, which really brought the IC disc back to life. It is important to note that since the interest charge was added in the 1980s, the IC disc hasn't been challenged under international trade agreements. This is the one that's survived these challenges. And on the U.S. side, I'm not aware of any tax professional who believes that an IC disc structure doesn't work to provide the benefits we're going to look at, provided that it's set up and used correctly. So let's next take a look at what the potential benefits to IC disc structures are, and then we'll talk specifically about what types of businesses could qualify to use one. As I mentioned, an IC disc is a separate company, and it's typically set up by shareholders of an existing business. or in some cases it's set up as a subsidiary of an existing business. That's more common in the case where the existing business is a partnership or an S corporation. You can set it up as a subsidiary in that case and get really the same results. I also mentioned that the benefit comes because income is shifted into the IC disc. So how does that work? The relationship between an IC disc and the existing business can either be set up as a buy-sell arrangement or a commission arrangement. So a buy-sell arrangement would mean that the IC disc actually purchases the products from the existing business for one price and then on-sells them to customers or whoever it sells to them next for another price and earns a profit. A much more simple and much more common way of structuring an IC disc is as a commission arrangement. Under this type of arrangement, the IC disc really doesn't have to do anything at all. It's basically just a paper corporation, although there are reasons in more complex structures to have it take on some functions that can increase the tax benefit. But regardless, the rules simply allow the existing business to pay a commission to the IC disc determined based upon the export income of the business. This commission is a deductible business expense, so it reduces the taxable income and thus the tax of the business. The IC disc itself is tax exempt, so it doesn't pay tax on the commission income that it receives. So the only tax on that income that can be shifted through the IC disc comes when the IC disc distributes those earnings to the shareholders or back to the business itself if it's, as I mentioned, if it's structured as a subsidiary of the business. This tax to the shareholders is at the lower dividend rate. So effectively, an IC disc structure turns a portion of a business's profits from ordinary income taxed at higher rates to dividends taxed at lower rates. And the deferral benefit that I mentioned earlier is still there as well. An IC disc doesn't have to distribute all of its income each year. It's permitted to retain an amount of income equal to what it earned from the related business's first $10 million of gross export receipts. So any tax that's deferred because of this is subject to an interest charge, but it's actually extremely low, especially right now. The interest charge is based on the one-year Treasury bill rate, which last time I checked was under 0.15%. I think it was 0.11% the last time I checked. So, this benefit is still there as well. Basically, it amounts to a very, very low interest loan from the government in the amount of the deferred tax. So obviously the benefit to an IC disc really comes down to how much income can be paid to the IC disc or shifted into the IC disc. The rules provide a few methods for calculating that amount of income. We'll call it the commission. That's typically how these are structured. The simplest method is what's called the 4% of gross receipts method. So a business can determine its total export receipts, its total gross receipts from export property, and we'll talk about what that is. And it can pay a commission to the IC disc equal to 4% of this. A more complex method is the 50% of taxable income method. Under this method, a business first separates its gross receipts into two buckets, basically, export receipts and non-export receipts. And then it must allocate all of its deductions and expenses and credits between these two buckets to basically arrive at what your net income, your net taxable income is in each bucket. The business can then pay a commission to the IC disc equal to 50% of the taxable income in that export bucket. So although this method is a lot more complicated and generally requires more compliance work, it also usually creates a much higher tax benefit. The exception there would be a business that has a lot of gross receipts but a very low profit margin. There are also a number of special pricing methods we'll call them, that can be used in doing this calculation. And we won't get into the nitty-gritty details of all of these. But the point really is that the extra work to do some of these complex calculations, more often than not, can be worth it because of the additional tax benefit it can generate by increasing the amount that ends up being shifted into the IC disk. States vary in the way that they treat IC disks. Some states just disregard the structure and say, we don't allow that deduction. So basically taxing the business the same as before. In other states, there may be a tax benefit. A lot of states don't have specific rules on point, so there's some gray area. But it's possible that there could be state tax benefits depending on where the business is located and other facts. So this is something that just needs to be analyzed on a case-by-case basis. This slide shows an example of an IC disk structure, a nice picture to help put an image to these concepts. So on the left, you can see a business operating without an IC disk. Basically, it's earning income from selling export property, and this business is taxed as a pass-through, either an S corporation or a partnership. And so the individual owners of this business are paying tax on the profits at ordinary income rates. Currently the highest rate is 39.6%, and then there are the potential additional Medicare taxes depending on whether the owners are active in the business or not. So you can, for a passive owner, you could end up with rates as high as 43.4%. On the right, it shows the same structure, but using an IC disk. The same gross receipts are being earned by the operating company, but now, instead of all of the income from those receipts being taxed as ordinary income, a portion is paid over to the IC disk as commission, and that's a deduction to the business, so it reduces the taxable income of the business. That amount is shifted over into the IC disk, is not taxed in the hands of the IC disk, and then when it's distributed as a dividend, so it's taxed at the lower dividend rates, which are 15 to 20% depending on the tax bracket of the taxpayer, plus potentially again the 3.8% additional Medicare tax. So who is eligible to benefit from an IC disk? As I mentioned before, an IC disk is a separate company that makes this election to be treated as an IC disk. In order to make this election and keep it effective year by year, certain requirements have to be met. Most of these are not requirements that would actually keep a business from using an IC disk in the first place, but rather are just things that need to be carefully monitored in designing the structure and going forward to ensure that there's continued compliance with the rules. Really the only sort of gatekeeper requirement that determines whether or not a business can use an IC disk is the requirement that the IC disk has to earn its income, i.e. the commission that we discussed, from qualified export receipts of the related business. So basically, a business can use an IC disk if it has qualified export receipts that are significant enough to make implementing the structure worthwhile. So before we look at the definition of qualified export receipts, I want to just define one other term, and that's the term export property. Because most types of qualified export receipts have to do with transactions involving, quote, export property. So the full definition of what export property is there on the slide. But in short, export property basically is property that is made in the U.S. and ultimately consumed abroad. Again, the business in question doesn't have to directly sell abroad as long as the sale can be traced and confirmed that the property was actually ultimately used or consumed outside of the U.S. A big issue that comes up here is what's considered made in the U.S. Just looking at the third prong of the test, it's apparent that products don't need to be wholly made in the U.S. There can be imported components. there's a number of detailed rules in the regulations that deal with this issue. But what I would say is that if you have a business that, for example, just buys products from China and then ships them over to Europe and doesn't do much else, that probably is not going to qualify. On the other hand, if you have a business that is doing anything to the product in the United States, it's worth looking into whether that activity might be enough, because the way the rules work, they'll often allow products to qualify even if they don't seem like they were made in the United States. You can see that the 50% of the value cannot come from imported components. One thing to keep in mind here, though, is that oftentimes things that are imported at a very low cost and then packaged into a product that ends up being sold for much more. So even if those components are a significant portion of the product, they may not be 50% of the value based on the price that they were purchased for. So next, qualified export receipts include a few things, but the main one is simply sales or rentals of this export property. So this could be, a Miley Cyrus poster that's made in the U.S. and sold ultimately to foreign customers, either directly or through an intermediary. Generally, income from performing services for foreign customers doesn't qualify, but there's a couple of exceptions to that rule. One is where services are performed incidental to the sale of products. So this could be paid service training sessions that are offered to customers who purchase a computer program that's made in the U.S. So if those were incidental to the sale of the computer program, the earnings from those services could qualify. The other exception is regarding certain engineering and architectural services that are provided for construction projects located outside of the U.S. I don't know why this particular exception made its way into the rules, but I guess engineers and architects just had a good lobby at the time. A final issue that comes up is with regard to sales involving intellectual property. Generally, sales or rentals, i.e. licenses, of intellectual property don't qualify. However, sales of articles of property which are protected by IP rights would qualify. So, for example, an author who licenses the rights to her book to a distributor and receives royalties from the distributor wouldn't qualify. But an author who sells individual copies of the book, even though they're protected by copyright laws, would qualify. And one exception to the exception here is for film and music rights, which for some reason were carved out by the rules. So someone who licenses music rights and receives royalties related to foreign sales would actually appear to qualify, even though those are royalties from intellectual property. So this next slide just puts some numbers to these concepts. On the left, you can see a business operating without an IC disc. Total gross receipts from selling export property are $5 million, and when we allocate all the deductions and expenses to those are $4 million, so we end up with taxable income from exports of $1 million. This is taxable to the this is a pass-through business, so we're assuming that the partners have a marginal tax rate of 35%. Now, that's not the highest rate anymore. But just for the sake of this example, we'll assume a tax rate of 35%. So that would leave total tax paid by the partners in this business or the owners of $350,000. On the right, you just see the same business, but what would happen with an IC disc. So we have total export receipts, again, of $5 million and taxable income after you allocate the expenses of $1 million. This is reduced in this case by the commission that this business is able to pay to the IC disc, which is we're going to use the 50% of taxable income method, which is $500,000. So that leaves only $500,000 in the business to be taxed at ordinary rates at this 35% rate, and the tax on that would be $175,000. The other $500,000 of profit that was shifted into the IC disc, again, can stay within the IC disc and subject to an interest charge on the deferred tax. or it can be eventually paid out back to the shareholders or back to the existing business. And when it does so, it will be taxed to the owners at the dividend rate, which for a taxpayer in the 35% bracket would be 15%. So the tax on that would only be $75,000, and when you add that to the $175,000 paid by the business or paid on the business profits, you end up with a total tax paid of $250,000, which you can see is $100,000 tax savings by using an IC DISC. So if a business can qualify, what goes into setting up an IC DISC? Although an IC DISC isn't a tax shelter, it does require special care in setting it up properly and doing the annual compliance properly. Failure to monitor the structure to ensure that it qualifies, can result in a loss of these benefits. So it can be a significant project to set up an IC DISC structure. But typically, for the right business, an IC DISC structure provides can provide significant benefits in the first year, even after all the setup costs and annual compliance costs. And going forward, the tax benefit is typically a significant multiple of any annual costs. People often ask if there's a rule of thumb as to how large a business would need to be to make it worthwhile to implement an IC DISC, and it really does vary depending on how complex the structure is going to be, how complex the compliance is going to be. In the example on the last slide, with the business generating $1 million of taxable income from its export sales, there was clearly a significant benefit and that would significantly outweigh the cost of setting a structure up for a business like that. If you reduce that number to, say, $100,000, you would likely find the benefit getting too small relative to the costs, unless the business had very high revenues and just a low profit margin. For a business in the $200,000 to $500,000 a year in export profits range, I would say it's definitely something that's worth at least looking into. Setup of an IC DISC structure begins usually with an analysis of the benefits and what the most efficient structure would be, and whether or not the business would qualify. A legal entity needs to be set up, so everything that goes with that, articles, bylaws, subscription agreements, resolutions. Also, it's important to put into place a commission agreement to document the arrangement between the existing business and the IC DISC for payment of those commissions. An IC DISC has to make an election in its first year, and every year after that has to make a new election. A written tax opinion should be produced by the advisor setting up the structure, and procedures for appropriately documenting the export transactions, documenting that the products were actually exported, need to be developed. And then annually, the structure needs to be monitored carefully to ensure that it continues to comply with the basic requirements. An annual election needs to be made for the company, and then the IC DISC commission needs to be calculated and documented. This is where analyzing the different methods and trying to figure out which one would produce the highest benefit comes in. And then the IC DISC files a separate tax return as well. So that's the end of the information I have. I hope this presentation was helpful and not too boring for those of you who didn't know what you're getting into. If anyone has any questions, I'd be happy to answer them now. And I think that you can ask questions by hitting the raise your hand button, which is on the bottom left of that little toolbar. And if you if you hit that button, I'll see you, and then I'll unmute your microphone. So does anyone have any questions? And my contact information is there. I'd be happy to talk more about these, about this or any other issues with anyone. So my email address is on there. I see James, let me pull you off mute here.
Should I go ahead?
Yeah, go ahead.
To what the corporations can do with the cash that they accumulate.
Okay, I think I got the last part of the question, but I think I know what you're getting at. I think, and tell me if this was not the question, but I mentioned the deferral benefit that this cash can sit within the IC disc and the tax can be deferred. And the question I think was, what can you do with that cash? Does it just have to sit there? And the answer is no. It can be used, either invested in certain things. This is where kind of monitoring some of these other requirements becomes much more important. But another option that can be done is what's called a producer's loan, which basically means that the IC disc can loan the money back to the operating business. And there are restrictions on this. So this is something that has to be. The basic restriction is that the loan back has to be used by the business to develop its export product or expand its facilities. It can't just be used on a totally unrelated project. But yeah, there are things that can be done to utilize this money rather than just having it sit there in a bank account. And James, I'm sorry, I still can't hear you, but I hope that answered your question.
It sure did. Thank you.
Okay, there we go. Okay, well, if there's no other questions, again, my email address and direct line is there, so feel free to reach out to me if you have any other questions. And otherwise, thanks everyone for joining.